Whenever we think of investing in mutual funds, we get to hear a term NAV and we get confused that what exactly is it? Is lower NAV better, or do we even need to care about it? In this video, we will try and answer all these questions. NAV stands for net asset value. In simple words, it is nothing but per unit value of a mutual fund scheme. Think of it as the price of a single unit of mutual fund scheme, but don't confuse it with stock price. NAV is calculated based on assets and liabilities, unlike demand and supply as it is the case with stock price. Assets can be anything that a fund owns, from stocks, bonds, government securities to even cash in the bank account. All of these things together form the assets of a mutual fund. There also are some expenses or liabilities like management fees, admin charges, or money owed by the fund. To know the real value of net asset, we subtract liabilities from assets. Once we know the net assets, we divide that number by the total number of units held by the investors, or we can say that the total units issued to the investors. This gives us the NAV or the net asset value. For better understanding, we will use an example. Suppose a fund has 100 crore rupees worth of assets and 2 crores in liabilities. Net asset will be equal to 98 crore rupees. Now suppose the fund has issued 10 crore units to the investors. So to get the NAV, we will divide 98 crores by 10 crore. So the NAV will be 9.8 rupees per unit. When we invest in a mutual fund scheme, we don't directly own stocks or bonds. We own units of the mutual fund scheme. Each unit has a value that is equal to the NAV. Suppose the NAV is 9.8 rupees and we invest 9800 rupees, we will get 1000 units of the mutual fund scheme. We observe that the NAV changes every day. But why? It is because the value of the fund's assets, that is stocks or bonds, change on daily basis. If the value of the asset rises, the NAV rises. If it falls, the NAV falls. That's why NAV is calculated at the end of each trading day. There is one most common misconception. Many new investors think a lower NAV means it is cheaper, hence better, and higher NAV means it is expensive. But it is not the case. The NAV only shows per unit value, not whether a scheme is cheap or costly. Think of it like a pizza. If one pizza is cut into 4 big slices, each costing rupees 150, and another is cut into 40 small slices, each costing rupees 15, the outcome remains same, just divided differently. Similarly, fund A may have NAV of rupees 15 because it has issued more units, and fund B may have NAV of 150 rupees because it has a fewer units. Now another question that comes to our mind is, if NAV doesn't tell us the scheme is cheap or expensive, why should I even care about it? So it is important because it helps us in knowing how many units will we receive. It helps us in calculating our portfolio value. It also makes the calculation of growth easier. Finally, don't confuse NAV with share price. A share price depends on demand and supply, but NAV is simply a book value calculation, that is assets minus liabilities divided by total outstanding units. Although changes in NAV is affected due to market movements as the funds invest in shares of the company, but the calculation is simple maths rather than demand and supply matrix. For more such videos, do like, subscribe and share. This video is only for educational purposes. Any information provided in this video is not to be assumed as an investment advice. Characters in this video are completely fictional. Please consult a professional before investing.